Okay, good morning, ladies and gentlemen, and welcome to the US CPI Prep with your host, Tony. I'm also the head financial analyst at Financial Juice. So we had PPI data yesterday, and that had a good market reaction, i.e. there was a strong market reaction. It wasn't as weak as it was in the past. If we're looking at it before, let's just grab it up, see. Yeah, so with inflation in the producer price area ticking up across the board, with the exception of the year on year, which had remained unchanged compared to the forecast. And then the markets or the US indexes stock indexes seeing a decline of that data. But CPI today, let's get through it. Which is the main event for the week. And first of all, what is it? Represents how much consumers are paying for retail goods and services. And there are 26,000 retail outlets, 4,000 housing units in 87 urban areas, and prices are collected on 80,000 goods. Okay, all right, that's fine. One of our guys had a big old sneeze. It's a bit awkward that came through. Anyway, let's get to it then. So I said, and 4,000 housing units in 87 urban areas, where prices are collected on 80,000 goods and services. So the key measurements then that make up the CPI report: you have housing, which represents about 42%, food and beverages 14%, transportation 18%, and medical care about 8.5%. Then you have the core CPI data, which excludes food and energy. So it makes the report less volatile by removing those the most volatile parts of the report. Seasonally adjusted is the preferred measure when looking at the economy to show for the month-on-month data to show where the economy is in regards to inflation without the effects of weather and production cycles and consumer spending patterns. Then the difference between PCE and CPI is that PCE places a low weight on prices of gasoline and of residential rents and focuses on the nation as a whole rather than just focusing on urban areas, which is what the Federal Reserve prefers to look at when having a look at how strong inflation is within the economy. How does it affect the markets? Very simple. If you haven't had a look at the markets whenever CPI has come out recently, or in the last couple of years or so, higher than expected data leads to a stronger dollar in anticipation that the central bank will keep rates where they are and maybe take longer to cut rates, or they could decide to hike interest rates. For the stock market, stock indexes, if you do see core inflation in particular rising, then that doesn't bode well for the stock indexes, and you see a more bearish reaction. So much stronger than expected data for CPI leads to a more bearish reaction for stock indexes. And for the bond market, bond yields, stronger than expected data, again similar to the dollar, leads to high yields in anticipation that the central bank will keep rates on hold or decide to hike rates. And on the flip side, bond prices will see a decline as yields go higher. So that's one thing that I think people sometimes kind of forget with the bond market, is that as bond prices go higher, bond yields go lower because there is more demand for it and the government is going to pay out less for those bonds that people are buying. And it's the same vice versa. Instead, if bond yields are going higher, bond prices are lower, then of course the government is open to paying more interest for somebody buying their debt. So the previous report in April, for the March report, increases were seen, this is in the month-on-month excluding food and energy, increases were seen in shelter, motor vehicle insurance, medical care, apparel and personal care. and decreases were seen in used cars and trucks, recreation, and new vehicles. So where is the economy at the moment? Non-farm payrolls came in at 175k compared to 315k, a marked decline for the month. Unemployment rate at 3.9% compared to 3.8%. Average hourly earnings declined to 3.9%. Employment costs ticked up to 1.2%. The PCE price index year on year at 2.7% compared to 2.5%. The core unchanged at 2.8%. ISM manufacturing prices paid ticked up to 60.9 compared to 55.8. Prices paid for services at 59.2 compared to 53.4. Productivity is 0.3% compared to 3.5. Import prices ticked higher to 0.4. Exports declined to 0.3%. PPI year on year, as said, the data that we had yesterday at 2.2% compared to the revised prior of 1.8%. The original prior was 2.1%. And core PPI year on year came in at 2.4% compared to 2.1%. All right, so the triggers then for the economic release of what we're looking at today with the CPI data, economists are looking at a high estimate of 3.5 with a low estimate of 3.2%. So a deviation of 0.1% on the high end and 0.2% on the low end. Core CPI year on year with a high estimate of 3.8% compared to 3.5, and with a deviation of 0.2% on the high end and 0.1% on the low end. Core CPI month on month with a high estimate of 0.4% and a low of 0.2%, and CPI month on month with a high estimate of 0.5% and a low estimate of 0.3%. So for those two releases, looking for 0.1% deviation on either end. This shows that the markets are going to be very sensitive to the CPI data anyway. So any sort of deviation that kind of comes in to the data, whether it be higher or lower, is going to bring about some volatility. There has been in the past, and we'll look at the market reactions and we'll go through it, where the data has been mixed or some of the parts of the data has come in line with expectation. And that's caused the markets to see a bit more of a erratic reaction within the markets. And there he goes again. I hope it doesn't become a feature of this stream. All right. Sentiment of views then. So from 7 to 2, Fed's Powell and the Fed made it clear that that only inflation is keeping them from cutting rates. This year, the market has gone from pricing almost 725 basis point cuts, starting as early as March, to now pricing in just under 2, with a start pushed to September. MUFG, they note that a fourth consecutive monthly upside inflation surprise is required to inject fresh upward momentum into US rates and the dollar in the near term, whereas inline or a softer print could see the dollar give back more of the gains from the start of this year. A fourth consecutive upside inflation surprise would increase the likelihood of the Fed dropping more rate cuts from the updated plans at the next FOMC meeting on the 12th of June, which is when we get the summary of economic projections with the expectations of where they see the federal funds rate, CPI, the PCE data, and GDP and unemployment and so on for the economy. Then Morgan Stanley, they said that while Wednesday's report would be critical for the timing of the first rate cut, regardless of the print, they remain confident that inflation will trend lower over the year, making the question when, not if, the Fed will cut. They say that if their forecast is correct, the April print on Wednesday will not represent a sea change, and if they are wrong, the market will likely adjust the implied timing of the first cut to earlier or later. But they do not think that the path for the year is likely to change much. Goldman Sachs said that during the past year, on the day of the CPI release, this is quite interesting and important to note, how big of a move do we usually get, not just in the short term, but over the day when the economic release comes about. They said that the S&P 500 has typically moved by 0.7% in absolute terms and 0.5% on all other days. When the inflation print was in line with consensus expectations, the one-day change in the S&P 500 index equaled 0. So that's quite important to note, is that when there is a deviation for the economic release, that there is an added volatility and more opportunities that are then presented to the market and to traders. But when the data is in line with expectation, there are more erratic moves that occur, and then the markets kind of peel back and then go back to their normal trading ways and kind of remain flat. But that's according to Goldman Sachs of what they've witnessed about how the CPI data affects the market. They say that a downside surprise versus consensus should further calm market fears about rate hikes and see the bond rally extend, while an upside surprise would create renewed risk for front end rates. So you're talking about the US 2-year Treasury bond. So that's what they're talking about. The smaller rates, or the rates that have a smaller dated or shorter dated rates. They said that whilst an upside surprise would create renewed risk for front end rates and volatility, akin to the reaction to the March CPI beat. Okay, so this print, in our eyes, as day traders in the short term, the volatility that's going to come about from it is going to be quite key to gauge. Well, of course, if the data is stronger or weaker, right, that's going to present us clear opportunities. When the data is in line with expectation, it's a bit more difficult to try and pinpoint how the market is going to go. There are two ways that it can go. One, the revisions for the PPI, those were on the Financial Streets feed that were put out. Yeah, it's readily available, and on the BLS report too, on for PPI, as it would be for the CPI report, and you can compare it really from the prior report and the current report. So yeah. So as I was saying, there are two ways it can go if the data is mixed or in line with expectations. One way you could go is that traders, if the data is, let's say, with the forecast today, that the forecast for CPI year on year is for year on year to go to 3.4%, and for the core to go to 3.6%. If the data is in line with expectation, inflation is going down, but not going down further enough for the markets to go yay or to celebrate. So then what could happen is you could get a whipsaw reaction from the S&P, where you might see initial decline, and then the stock indexes start to move back up because inflation is still going down. It's not overheating. The other scenario that could occur is if data comes in line with expectation, is that the markets could take that as saying, yeah, inflation isn't going to go higher, and instead of seeing a decline, you see a little bit of a rally that occurs, but then is kind of muted, or doesn't really carry on for so long throughout the day. Hence, it's better to get data that shows clear deviations across the board when that's occurred in the past. And if you've seen the ranges and deviations sheet, that's when the better opportunities are then provided to you, because the market is clear in which direction it wants to go. The sentiment either becomes cemented that central bank may decide to cut rates in September or even earlier, depending on how strong the data is, or it goes the other way around if data is stronger than expected. So clear-cut deviations on which in either way provides us the clearest direction or clearest opportunities to trade the economic release. When it's mixed, then you're in a bit of trouble. So, and then you're looking to how the markets react, and then it's just down to yourself and what you decide to do individually, whether you jump in and try and capitalize on the small opportunities that come into the market, or whether you just stay away from it altogether. If you take a position beforehand, I mean, good luck. If you decide to put in an order before the release has come out, then God bless and Godspeed. Hey, it could work, but yeah, it would just seem quite crazy. Anyway, let's carry on. So we've seen the sentiment and views of the investment banks. Fed and government views. So Fed's Powell on May 1st said that we do need to take signal from 3 worse than expected inflation readings, okay? And that we believe our policy over time is sufficiently restrictive to bringing inflation back down to 2%. And then on May 14th, Powell said that my confidence in inflation moving back down is lower than it was. And it looks like it will take longer to get inflation confidence. I wouldn't call the PPI reading hot, but sort of mixed. And he also added that I don't think it's likely that the next move would be a rate hike. It's more likely that we would hold policy rate where it is. So off the back of that comment that Powell made, the S&P 500 had strengthened. Fed Schmidt said that interest rates could remain elevated for an extended period of time and sees indications of inflation easing. And Fed's Mester said it's too early to really conclude that we stalled out or that inflation is going to reverse. And then market pricing, you had on April 25th, Fed swaps no longer fully price in a rate cut before December. May 1st, post the Fed meeting, traders see the Fed rate cut most likely in November, and they see smaller chance of no Fed rate cut this year after the meeting. Traders also price in September as the likely time for the first rate cut versus November, seen before Powell's comments. And traders reduce bets that the Fed will not cut rates at all this year, and add to bets that the first rate cut comes in September. So Powell in his last press conference was being a bit more dovish than expected, and that had led to the move, or not being as hawkish as the markets had expected, let's say. And that gave some relief to the markets that the central bank isn't looking to tighten further, that they're not making any new comments that inflation is getting out of hand, or there may be a need to raise rates in the future. And then May 14th, post the PPI data yesterday, traders pair bets on Fed rate cut in September. So this was the market reaction for CPI last time around. I wasn't here to do the live stream, but you can see on the dollar index, which if we look at the dollar yen, you would have seen the strength from the dollar there. And if you're trading currencies, you had a nice opportunity to kind of carry on with the trade because of the clear-cut deviation that was made from the release. The S&P 500 also had a nice reaction too, as did US government bonds, 2-year bonds. All right, let's get out of this here. I want to go through the deviations with you guys and make that kind of clear and explain to you how the deviations work. So let's bring this baby here. Here we are. Okay. So, right. So with the economic release last time around, data was stronger than expected by 0.1% of deviation. More or less what economists are looking at today for deviations on the high and low end, and probably will be the same for today as well. But the market reaction was, if you can see, we had on the NASDAQ, on the NQ, 954 ticks towards the downside on the initial market reaction, okay? This first figure represents the initial market reaction going to the wick of the candle, all right? The figure in the black brackets represents the market reaction 10 minutes after the release has occurred, going to the end of the candle. And in the blue brackets, this represents a move after 30 minutes. So if we look at the past reaction, if we're going all the way back to December of 2022, this is the largest reaction since then, since December 2022. So because the reason why that's happening is because of how close we are to the central bank and how close the central bank is to making the decision of when to cut interest rates. So markets become more sensitive to what the central bank is doing when they're close to pivoting or when they're close to switching up their interest rates. And that's very evident in the past of what we've seen here. So during these months in the past, when inflation was continuing to tick higher, and there wasn't any relief, and it was a bit harder, and the central bank was more laser focused on the inflation data back then. Well, they still are, but not as much as they were back then. You can see how the markets had on the NQ, you had seen 1,407 ticks to the downside. And then the biggest market reaction that we had was in November of 2022 of 1,500 ticks. Okay. And then over time, when things kind of cooled down and calmed down, and the central bank still being focused on inflation, but is seeing the work being done for inflation to head towards the 2% target, the market reactions kind of become a little bit more quiet. But as policy starts to change and the direction of the Fed starts to change, then the sentiment also starts to change and it starts to pick up in volatility within the markets. And then you get bigger opportunities that are presented to you within the markets. Okay, so we can see here on the S&P, there's 219 ticks towards the downside. I'm just having a look back. What was the last time it happened? Yeah, which is the biggest, again, since December. Again, December 2022. We're looking at the Dow or the YM, 121 ticks down there. Yeah, not as big as it was before, but still seeing a nice, decent, solid reaction. We're looking at the currency pairs. Usually it's been, or what's been in the lead has been the dollar yen, which has seen the largest market reaction. But if we see, you can see here on par with the dollar yen is the Aussie dollar, which was at the same level, or let's say had the same market reaction size in pips. So you had 52.5 pips down on the Aussie dollar, and on the dollar yen there was 52.5 pips towards the upside. So those two currencies is something to just be aware of. Usually you can see that the Aussie dollar hasn't seen the biggest market reaction before, but things are starting to, so that's something just to keep an eye on as an outlier currency pair. But the dollar yen historically has seen the biggest market reaction out of everyone else in the currency space. Then if you're looking at dollar Swiss franc, usually again that usually doesn't see the biggest market reaction, but last time around it did. With the New Zealand dollar, again same thing, but it's usually been dollar yen, GBP USD, and also euro dollar that have seen the biggest currency pair moves within the markets. Okay, so we've got about 6 minutes left. So if you want to have access to the MACROACE ranges and deviations sheet, or again, if you're not sure what it does, it shows you how big the market reaction, how much the markets have reacted to economic releases. It gives you a breakdown the first minutes, or going to the wick of the candle, the first 10 minutes, and also the first 30 minutes of the economic release. So you get a good idea, you get a good sense of how strong was the initial move, how much of a pullback was there, or did the market continue to go, or did the asset or whatever you're looking at continued going in the same direction, or how quick was the reversal. And then after 30 minutes, how long did that, were there any further moves, or did it kind of just stay in, or did it just kind of look like a flat line and kind of just go up and down a little bit, but not by much? So this information is useful because it gives you a sense as to how long and whether or not you should take the trade, depending on past economic release data. And that's down to your discretion, whether or not you take the trade. But having this here, this historical data, to see how big the markets have reacted, to then gauge, right, if I see a 0.1% deviation in all the economic releases for the CPI data, I'm looking to maybe take, maybe sell, maybe I'll sell the NQ and look for about a 70 tick profit, although that's quite small. Doesn't matter. Whatever target you have, you go for it. Just as an example, and then I'll have a stop loss at around maybe 35 or something like that. Okay, or maybe I'll wait for the markets to see the initial reaction, hold it for about 10 minutes, or hold it for about a couple of minutes, and then there may be, historically what we've seen is that there may have been a reversal within the 10-minute mark of the market, of the release that's occurred, and then I might jump out. There are so many different things you can do with it. Okay, it's just giving you an example of what you can do with the information. Hence, this information being clear and easier for you to understand how the markets are going to react. Also, what is the sentiment for the economic release too? If there has been a big market reaction, why, compared to other economic releases? Then you will have a better understanding. If I've got it here, I believe I have the sentiment. So we've started adding the sentiment side to it as well for the economic releases, like we did with PPI yesterday. If I just bring that up, yeah. So sentiment is also there as well. So you can see which releases are going to have the most, or are having the most impact on the markets. It is new, that feature for the sentiment for the economic releases. Usually I've done it for the interest rates only, but it's important to do for the economic releases. So then, as said, you know which releases are having the most impact, and those are the releases that we're going to be focusing on a lot more. Okay, about 3 minutes left. So if you want to get access to the MACROACE regions, deviations and ranges, all you've got to do is subscribe to the MACROACE mailing list, which is here. Okay, that's that there. So that gives you access to the deviations and ranges sheet. You'll get an email on Monday, which is, so it's only one email a week. You'll get an email on Monday with the link to the ranges and deviations sheet. Of course, if you've signed up, it's completely free. You don't have to pay for anything. All you got to do is sign up to the MACROACE mailing list, and you get to enjoy the ranges and deviations sheet. Okay, and here we're also putting in the ranges for the week ahead as well for other economic releases that are likely going to move the market or move certain markets in this part here, if you haven't seen it before. All right, let me move this out of the way because I do also want to show you one more thing too with the ranges and deviations. So I'll highlight that for myself. Okay, we've got 1 minute to go, and let's get the release underway. Let's get out of here. All right, so I'm going to go silent for one bit. Let's go here. Get, what do we got? All right, I'm going to go silent at the around the 10-second mark, but good luck. Okay, so data was in line with expectation. The S&P, of course, you can see moving towards the upside. So in this scenario then, with the data that was in line with expectation, inflation continuing to move towards the downside, markets are took that into the positive note of seeing that inflation it's coming down, it's not going any higher. The central bank isn't going to say that, okay, this is a bad thing, that inflation isn't coming down fast enough. If we're looking at the expectations then, so you can see here traders firm up bets on Fed rate cuts in September and December after the CPI data had occurred. So a bit better for the risk on sentiment then for the markets. You can see gold moving towards the upside, the dollar yen taking a hit there. If we look at other areas, the NQ still up on the release. Don't forget, if you found the information useful, don't forget to give the video a like, subscribe to the channel, get the word out there, and give the video a like as well. So we'll see. Okay, so seeing with TICKSTRIKE, the selling data coming in. See how long it kind of lasts, or if the markets will continue to try and pump towards the upside here. You gained $11. That's still good. Still good. Well done. That's every bit of profit helps. So that's good. Okay, so I did take a reversal here. I think we'll I think we'll close out on that. So yeah. All right. So that's that done there, and let's kind of get this out of the way. Hold on. This is stuck. Uh-oh. There we go. Okay. Alrighty. So there we go. So as I was saying, as you'd seen, I took a little short reversal at the top there. The initial position that I had did well. To take in to jump into the market and buy it up on the NQ, and then yeah, so 2 trades done, and that is me done for the day there so far. So what else we got here? Well, we got UK rate futures also being affected too. Also ECB traders and ECB rates being affected for the expectations. So traders slightly add to ECB easing bets in 2024 after inflation data and see 73 basis points from 71. Not too much of a difference, but still a positive reaction there. UK rate futures fully priced in 225 basis point rate cuts by the BV by November, up slightly from 47 basis points of cuts before the CPI data. So this is also very important to note with how the US data has an effect on other areas or other economies too, and the expectation for rate cuts. So Fed swaps price in faster pace of 2024 rate cuts after the CPI data. Okay, so this is what I wanted to explain to you guys then. With Financial Juice, let me just move this out of the way. You can see what I'm looking at here. So Financial Juice provides you with a live voice and text service to keep you in the know of what's going on with the markets, what's going on in the global economy, or maybe there's a central bank speaker that said something, or if there's been a sentiment change. That's what Financial Juice is all about, to keep you in the know of what's going on within the markets, live and in real time, on one platform here on the newsfeed, as you can see. Okay, so a bit of selling coming through on the indexes and some of the other currencies too. What we got? It's a bit mixed. Just mainly the indexes, so a bit of selling there. But yes, as I was saying, Financial Juice keeping you up to date, in the know, and being on the bleeding edge of news as to what's going on with the markets, and keeping up to date throughout the day, 24/7, with a live voice and text feed. Okay, so you have your voice here, live voice, which is here in this button, which you should be able to see. Hopefully, yeah, there you go. That's where the live voice plays, where the analysts are keeping up to date with the headlines that are coming through. And then those headlines that are said and then appear on the financial news feed here in the center as well, with an update as to what's being said. Okay, we also have our new little feature too with FJ Elite. So I don't know if you guys have know Arno, but Arno is providing little updates here and there, or very good high quality content of giving a breakdown of economic releases, the sentiment, the day ahead of what to expect, and any other things that will be important to your trading day on the FJ Elite part here that you can see here. Okay, of course you can give your feedback, which is it's a bit grey, but you can give your feedback there on that little button. All right, now with Financial Juice, if you're not familiar with it or if you've never come across it before, then best thing to do is to just sign up to Financial Juice, which will give you the light version. Okay, which is, yes, correctly said, it's Final Classic TV, which is the free version of Financial Juice. It provides you with what's going on. It still provides you with the same content, but it's just delayed. There are adverts that are played on the light version. You don't have access to the news desk to ask us or the analysts questions about what's moving in the market or why, or what to keep an eye out for the day ahead, for economic releases or speakers, if you had any other questions like that. So the light version is restricted, we put it that way, and it's delayed. It doesn't give you the full experience of Financial Juice Pro, but if it's your first time coming across a live voice and text service, have a play with the free version. It's still quite useful to be able to understand how that kind of service, how a service works. And then when you're familiar with it and you have a better understanding and you feel a bit more comfortable, then what you can do is then you can subscribe to the Financial Juice Pro version. Financial Juice Pro, it gives you as I said, all the features that you can see on the site here. There are no delays, there are no adverts, everything's live and in real time, and you have access to the news desk to be able to ask us questions as to what's going on within the markets and so on. But that's the key thing about news, is that fundamental news will affect how the markets move, and then it's down to technicals and then down to your own decision. Yeah, you could just trade how the markets are moving. Sure, that's fine. But if you know why the markets are moving, and if you have that knowledge behind you, right, then then you get a better sense and you're in a better position to then take a trade or manage your risk within the market. So I'm just going to show you our market moving area as to why news is important. Here, where you may have had comments, as you can see here, look, with Fed Powell, where he's commented in the past, and how that's affected the markets. If we scroll down, let's get some other comments here. Governor Bailey last Thursday, when we were going through the rate decision, the initial market reaction from the pound was it had declined because you had Dinger and Ramsden that voted for a cut. Then after that, the markets were trying to recuperate, the cable's trying to recuperate its losses. But then Bailey said that headline, and you saw another decline on cable from that headline that had appeared there. So you can't put off economic, again here, an example of where news has come out and then the markets have moved with Al Jazeera, with the Hamas headlines, and then how the oil market moves. You can't put the news off. And then try and trade the markets blind entirely. Of course, yeah, if it's worked for you in the past, if it's just trading technicals, then fine. But those opportunities where a headline has come through and it's going to change the sentiment or the way the markets move, why not take that opportunity, right? Rather than being like, ooh, and then just kind of like jumping in blindly. have an understanding of what's going on, right? Be more prepared. But do that if you're comfortable and if you like the product and the service that we're providing to you. So it's totally down to you and what you want to do. So if you do decide that Financial Juice Pro is something that you want to subscribe to, then first of all, make an account on the FJ Lite version. If you don't have a Financial Juice account, go to your email, and then what you do is just activate or just confirm your account through your email. Once you've done that, go back to the FJ site, and then you'll see like a little button here in the top left, you can see, where it says Go Pro. Click that, select your subscription. Then once you've paid, log out, log back in, and then you'll get the Pro version of Financial Juice. But there is a special promo that we have going on at the moment. And that promo is, instead of paying for a yearly subscription for Financial Juice Pro for $1,200 a year, you can get 92% off. That's right, 92% off Financial Juice Pro for a year and pay $99 for a year instead with our promo code JUICY92. Again, instead of paying $1,200 for a year, you get Financial Juice Pro for $99 a year with our promo code JUICY92. So if I just put this link here for you guys to be able to have a look at. There you go. That's the link to go to the Financial Juice Pro, and this is the promo code JUICY92. So I'm just going to pin this in the chat for you guys so you can see that. Okay. Billy Goat said, "Is gold good to buy?" That's down to you, buddy. I'm not going to say, and I can't say whether it's good to buy or not. Totally down to your discretion. A key thing with this. So just to clarify what these live streams are all about, it's providing you the information that you need and an understanding of the economic releases to then make your own informed decisions. Okay, and that's also what the deviations and the deviation spreadsheet is there for, is to help you make your own informed decisions as to what you should do yourself. Okay, based on past data and what the current sentiment is of the markets and what's been said by central bankers and investment banks too. Okay, so yeah, that should hopefully that kind of clears that up for you. But yeah, I won't tell you whether it's a good time to buy or sell, buy into gold. Totally down to you. But if we were looking at the deviations, then if we're looking at let me bring it up here for you. Let's look at the past data with CPI. Okay, gold. Well, that was a reaction for gold last time round. Okay, so you had seen 171 ticks was the downside in April, and after about 10 minutes of trading, it was still down, but had kind of recouped some of its losses, but it was still down by 108 ticks, and after 30 minutes, it was down by 30, and that was with a 0.1% deviation across the board for the economic releases. If you're looking at where data has been, kind of a look. That kind of looks like what it's like today, ish. Yeah. That kind of looks like it. Let's see. Sorry, I know I've got TICKSTRIKE in the way, but I want to keep it up. Yeah, when it's a big mix like last year, back in August 2023, it's seen a bit more of a muted reaction after the initial reaction. So it kind of tried to level itself out over the 10-minute period. So yeah, totally down to you how you play it, what you want to do. Let's see what this is. Yeah, data was bad. It was stronger than expected. Completely up to you. But also have just to be aware of how the market correlations too. So if you do see that the dollar has weakened, gold will usually see strength, as will the stock indexes, depending on what the data is that you're looking at. Okay, there are also different reasons as to why gold will move up in tandem with the stock indexes. Yeah, that's all down to market correlations, and at the moment you're seeing them moving in the same direction. Okay, totally down to you. That's all I'm going to say. Yes, so Santiago, you said, what about TickStrike? Is it included in the subscription? No, it is not. It is a separate product. But I can see why you might be asking that, because here on the Financial News newsfeed, whether you're a pro or light member, you have a restricted version of TickStrike, which is limited to 4 assets: S&P, Eurodollar, oil, and Bitcoin. And the level of sensitivity is also restricted to, I think, 6. I'll explain what the level of sensitivity means in a second. But the free version is, if you want to have a look at the free version, have a little play with it, get an understanding, get to grips with it. Fine, have a look. Yeah, here we go. That's the link to TickStrike there. But let me explain TickStrike, and for those of you who might not know what it is, or have never come across it before, or thinking, what are those green and red lights going off for on a screen? Well, TickStrike allows you to see the buying and selling momentum, as you can see here. See that buying power coming in. I wonder if it's going to go above this level. Sorry, give me one moment. Let's see. There we go. Let's see how that plays there. Okay. All right, I've got that there now. Right, so as I was saying, TickStrike allows you to see how strong the buying or selling momentum is within different asset classes, in Forex, in stocks, in futures, and so you will be able to see commodities with stock indexes and so on, ETFs and ETNs, crypto as well, and your internals like the VIX or the ADD. So you can have a look at those all in one place to be able to see how strong the buying and selling momentum is of the asset, visually and audibly, through these ticker boxes that we have here. So if I bring up this box, which represents the S&P, so this represents the buying and selling momentum here and how strong that is. And you have different numbers, or you have different levels of sensitivity. Okay, one is very sensitive. So when there's a little bit of buying or selling that occurs, only then will TickStrike will give you a visual and audio alert to that strength in the momentum. And as you increase the number all the way to 15, and you can kind of chop and change it as you want as you go higher, or whichever way, 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that occurs will TickStrike give you a visual and audio alert to what's going on within the market, okay, or the strength of buying or selling momentum. So if you're a day trader, again, you're looking for those opportunities that appear or looking to manage your risk within the markets, then having TickStrike there gives you that ability to help you identify those potential risks or opportunities that could appear within the market. Especially if there's been, let's say if there has been a bit of news and then you see TickStrike go mad, or you guys can't hear it now, but I can hear TickStrike sounds popping off. If it goes mad, you know something's happened in the market. Okay, you could be looking at one area of the market, let's say just the S&P 500. But let's say in the other area of the market, let's say in a different asset class, in gold, something's popped off, and you hear and you see gold, the ticker here going crazy, right? Then again, it's alerting you to those opportunities that could be presented, are being presented in the market, or maybe you do have a position within gold, and you might be monitoring it, but in case you're for some reason you're not, then you can hear it, or you can have a look at the ticker box and see what's going on. Go around your house, make a cup of tea, listen to TickStrike going off in the background. Give your dog a walk in your front room. I don't know how far your Bluetooth headsets can go, but or unless unless you've got a really really good headsets. I don't really think they can go that far. I think it's about I think with my one it's about 10 meters. It's not that bad, but it's not amazing, but it's all right. It's decent. Anyway, back to the picture. Okay, back to the main point. So TICKSTRIKE, if you're a day trader, shows you how strong the buying or selling momentum is within the markets, and you can see that here. Now, if you like to scalp the markets or do some extreme scalping of opportunities from the volatility or the strength in the buying or selling momentum, this lightning bolt button here, okay, if one is very sensitive to market reactions, this goes 15 levels below 1. So then it is uber sensitive to market reactions. And I'll move the mouse away, and then you can see how it differentiates between the other tickers that we have here. So if I move that out of the way, so any little bit of buying or selling momentum that occurs, you can see that on the lightning bolt version of TICKSTRIKE. And of course, you can chop and change that to wherever you want it to be, and make use of it however you want to make use of it. And that is there for you to have a little play with too. Okay, so I've already put the link in the chat for you to be able to have a look at TICKSTRIKE. As said on the website, there is the free version. So if you're not sure as to how you can use TICKSTRIKE, then have a little play with that. And then when you're ready, then use the link there. We'll take down that link, and then sign up to TICKSTRIKE, and you get the full version, which if I just bring it here for you guys. So this is the table of all the tickers that we have available. So I said FX, you have crypto, you've got your futures in the different spaces, commodities, stock indexes, bonds, with currencies as well. And if we're looking at the other areas too, all the commodities, bonds, stocks, ETFs and ETNs, and my PC was a bit slow, but there we go. So you can have a look at all of those there, and to see which active ones you have at the moment, you can just click on this button here. Then there is also one of the extra cool feature, which is workspaces. Well, let's bring it up here, which is workspaces. So if you do have, let's say, as said, today we had US releases. So I have my US releases here. And then if I want to go to my EU releases, then I just click that there, and it'll take me to my EU release tickers, and it'll set that up there for me, wherever I'd set it up beforehand. Okay. And you can save that as you want. So it's really useful to be able to have that in your back pocket, to see how strong the buying or selling momentum is. All right, so that concludes the live stream for Financial Juice. Don't forget to give us a like, share the video, subscribe to the channel, get the word out there if you found the information useful. Don't forget to also sign up to the MACROACE main list. Have a play with the ranges and deviations. It looks a bit complicated, but once you kind of get used to it and then you have an understanding of how things work, then it'll provide you with better preparation and being more informed in your decision making as to whether or not you take a trade or not. All right. Okay. Have a lovely rest of week. Enjoy your weekend, and I will see you next time. Remember, 1 email a week on a Monday. I'll send the email for the weekend. Actually, I do want to show you one thing too, which is how the emails look, just to kind of give you an idea. Okay, so here we are. Let's just close TICKSTRIKE for now. Okay, so this is how the emails look. Right, you get a summary of the week ahead in Asia, Europe, and the US, and a summary of what's happened in the prior week, if there has been any important news or anything that's moved the markets. You get a summary of the markets here in if with commodities, bonds, and FX. Any news that's happened over the weekend, if there's been anything important. You get the links to the deviations there, the live streams on here, and anything that we'll be covering for the week ahead. So there's not a lot of information that is there because this is supposed to act as like a refresher. And in the live streams, we go through in detail about what to expect for the economic release. I go through the sentiment and analysis other investment banks have given. Although it is a little bit, there is some bits here and there in the email itself. All right, that's all I want to show. Senpai. Well, that's the first time I've ever heard that. Well, thank you very much. All right. Take care, everyone. And I will see you guys next time.